Hello everyone and welcome back to the Cedi Investor. In today's video, we have something very special: stock recommendations by top analysts. Now, these companies are brokerages in Ghana. They know what they are doing. They have a lot of resources, and their analysts, I'm assuming they are experts at their job. I know they've been surveying, they've been looking at the market for some time now. So I'm very interested to know what these analysts think. What do they think about some of the stocks? Some of them I own them, some of them I don't. We'll go over them and I'll give you my thoughts and commentary on these particular stocks. Do I agree with them? Do I not agree with them? Are they making sense or not? So we have a lot to unpack in this particular episode. Let's get into it. Starting off with Scalcom PLC, it's known as MTN, that's what everyone calls it. And before we start, this report is from one of my brokers, SIC. So shout outs to them for this amazing report. We'll go over it. I'm going to read through it and give my thoughts. Do I agree with them or not? Let's start with Scalcom PLC. MTN's Ghana Q2 2025 results shows superior growth compared to the same period, with its revenue up 39% to 11 billion compared to 8 billion last year, Q2 2024. The middle lines also recorded growth year on year, with EBITDA. If you don't know what that is, it's earnings before interest, taxes, depreciation and amortization, or you could just say operating profits. It's up 45% to 6 billion compared to a 31% growth of 4 billion in Q2, as well as profit after tax going up 57%. So basically, they are showing us the metrics of MTN, its revenues, its operating profits, its profit as well. They all went up in Q2 2025 compared to Q2 2024. So that's very good to see. The business growth is chiefly attributable to expansions of its network capacity, digital platform upgrades and improvements in customer experience, which have grown customer adoption and usage across all business lines. Total assets and total equity also recorded 9% and 4% rises respectively. So basically, they are saying the reason why MTN's revenue went up is because of their network capacity expansion. So basically, what they are saying is that MTN is growing its revenue, growing its profits, because they are offering better services, improvements in customer experience. So they are offering better services compared to that of its competitors. They are also saying that MTN is expanding its network capacity so that they are able to reach more customers. And we can see that in the numbers. We can see that the active subscribers of MTN is always increasing. So that's very good to see. And we can also see that it's a digital platform upgrades. Basically, MTN is offering better services, reaching more customers, offering better experiences and expanding its network so that more customers are able to use these particular services, which is definitely going to improve upon its revenues. The stock is trading at a PE of 7.4 and a 52-week high of 4.1 and a 52-week low of 2.1. Also, the PE has ranged between 4.3 and 8.8 over the last 5 years. MTN has been consistent with its dividend paying policy, with its most recent dividend payment of 0.08 per share, representing a 23% year-on-year gain. This aligns with MTN's long-term target of 60 to 80% dividend payout. We project a 5.33 share price for the next 12 months. So yeah, they are saying that MTN is consistently paying out dividends. They are paying between 60 to 80% of their profits out as dividends, and we can see that MTN has consistently been doing that. They have a PE of 7.4, and the range they give MTN's PE, they said it has been trading between 4.3 8.6, and they are projecting a share price of 5.833. One thing that's probably I would say that I would have liked for them to add is that MTN is trading at all-time highs. Now, obviously, since they did this video, MTN has moved up. The price is now trading around is it 4.52 or something like that. So it has moved up massively. They have a forward PE of 5.75, indicating that they are assuming that the revenue growth of MTN is going to be sustained or even improve, which is going to bring down, it's going to increase the earnings per share, which will bring the PE ratio, the forward PE ratio, very down to 5.75. And the share price of 5.33, I think when I did my DCF, I was getting around 5.08. So it's very similar as to where I do think MTN should be in terms of fair price, which MTN has moved towards right now. So I would say that, yeah, overall, I do agree to an extent with them over this report. I'm not really seeing anything that I would say I heavily disagree with. But I would indicate that MTN is trading at a massive valuation. I think the company is trading at fair, closer to premium valuation. It's almost at even this 5.3 level. I would say around 5.08, but very, very close. So all good. Let's move to the next one. Up next, we have Total Energies Marketing Ghana, or Total Ghana. We maintain our long-term buy recommendation on Total. The counter is trading at 35 Ghana cedis, a PE multiple of 11.67, and return on equity of 33.15%, representing a greater 81 percentage point rise compared to the 10% percentage point decline in Q2 2024. This indicates enhanced return on shareholder funds amid strong profit growth. We believe the strong industry position and the still high demand for energy sets it up to sustain its superior business performance and return on shareholder funds. Total dividends payouts have historically exceeded that of its competitors, with its latest dividend yield reading of 7.32%. Hence, investors with an appetite for dividends are encouraged to take buying positions in this counter. Now, starting off, they are maintaining a long-term buy recommendation on Total. If you've been on this channel for a while, I think you know my thoughts on Total. When it comes to my investment strategy, I tend to stay away from fuel companies, especially in Ghana, and that's because they are low margin business. In terms of their recommendation, I personally wouldn't really recommend it as a long-term buy. I would be looking more of as a hold position. So if it's a company you already hold, I would, my recommendation will more be likely towards a hold for you to continue holding that particular company rather than a long-term buy. And also, when it comes to the dividends, yes, they are historically exceeded that of its competitor. Their main competitor in Ghana, which is also listed on the Ghana Stock Exchange, is Gold. And yes, they have been historically paying out better dividend yields than Gold, but to say that the dividend yield of 7.3% is a strong, is encouraging investors to take buying positions, I strongly disagree with this point. 7.3%, I don't know who is being encouraged by this. Gold is giving about 2%, which is very, 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 very low. But 7%, come on, like seriously. Treasury bills is even 10%. So if yields on treasury is 10%, I don't know which investor is being encouraged by a 7%. So I do disagree with this. I think it's still a very relatively low dividend yield. And for me to be, encouraged to take up a buying position in a company that I do consider as trading at high to premium valuation, I would be expecting the dividend yield to be way higher than that of treasury bill yields. We believe Total Energy is poised for sustained growth driven by its renewable energy expansion, fuel sales growth, and digital transformation efforts. Total has traded at a 52-week high of 35.07 and a 52-week low of 12.36, with a PE ranging between 3 and 11 over the last 5 years. We estimate a forward PE ratio of 8.97 and a price target of 45.49 over the next 12 months. So where should I start from? There's a lot of information that I want to, talk about. Let's start here with the last statement, their price target of 45.49 over the next 12 months. Now, like I said, we all don't know why a stock price is going to go up is relatively dependent on demand and supply. So whilst the stock price might move to this particular level, the thing that we as investors should note is it actually worth it? That's one thing we have to understand. And I can boldly say here that the 45.49 is too much, is just too much of a premium value for Total Energies. Even looking at the forward PE of 8.97, for this to be achieved, basically Total Energies right here, look at their revenue of 7.24 billion, and they have an earnings per share, earnings per share of 3.08, and also their net income is 344. This is giving us a current PE ratio of 12. When they did their report, it was around 11.9, but right now it's around 12, a 12 PE. Very, very high PE. For their forward PE to go to 8.9, like what they are saying, I did the math and I realized that for them to be able to achieve what they are saying, Total Energies needs to grow its revenue from 7.2 to 9.2 billion within that next year period for them to be able to make that 8.97 P ratio. Over the past 3 years, we can see they've been growing their revenue by 15%. So to go from 15 to 28% is, quite a big ask for me. In the same period, their net income right here should go from 344 million to 461 million for them to be able to get the PE ratio of 8.97, and that's with an earnings per share of 3.08. So based on my calculation, this forward PE ratio of 8.97 is I think is quite a stretch. It's going to be very difficult for Total to get this forward PE within the next 12 months. And also when it comes to the price targets of 45, like I said, I think that's just a huge premium valuation that they are giving Total Energy, and I totally disagree with it. So that is my thoughts on Total. Let's move on to the last one for today. For the first half of 2025, GCB has followed a strong financial performance in Q1, further improving its capital adequacy ratio, non-performing loan, and financial soundness indicator. Specifically, its CAR, capital adequacy ratio, sits at 20%, well above the regulatory minimum of 10%. NPL also has improved to 13.8 from 19.9%, while its liquid ratio grew to 76%. These have been supported by profit growth driven by expanded lending, growth in fee-based revenue, and operational cost efficiency. Looking ahead, we believe it is well positioned to sustain its growth trajectory, leveraging its robust financial base and strategic focus on customer satisfaction and digital innovation. The counter is trading at 14 right now, 15. We recommend investors with a long-term view to take buying positions in the counter. You can see some indicators here: capital adequacy ratio, how financially sound the business is, well above industry average. NPL is improving massively now, 13.8, and they said the growth was driven by expanded lending. This was what I was begging for, asking for. I think over the second quarter, GCB, they introduced this new trend, which is, what was it? Salary workers can get up to like 50% of their salary or something like that. So yeah, I think the rate was around 20%. I don't remember exactly. But I think more banks should be doing this. We have customer deposits going up, which is very good because it means more money is coming into the bank's hands. Even though it's liability, they still have more money to work with and make more return. GCB's PE ratio has ranged between 1.3 and 3 over the last 5 years, and we estimate a forward PE ratio of 1.5 over the next 12 months. The share price of the company currently trading at an all-time high of 14, now 15 Ghana cedis. Year low of 5.9, and a PB. If you don't know what PB is price to book. So basically, what you as an investor is paying for the company's net assets, which is recorded on its books. So the company's true net value or net assets. Yeah, I hope that makes sense. Suggesting that the company is undervalued by the market. So usually if PB is below 1, we assume that it's undervalued. So it's trading at 0.71. So basically it's indicating that the amount of money you are paying for the actual net assets of the company is relatively very cheap, below 1. Hence, we see an opportunity to buy cheap in wait of the 20.28 per share price forecast. Also, we expect a sustained return to dividend payments, having paid out 1 Ghana Cedi per share dividends for 2024. That one, maybe I would say I would wait until the end of the year, because remember the BOG has said that I don't know if it's next year or next 2 years, but if your NPL is above 10%, you are not allowed to pay dividends to your shareholders. And right now, Cowbank is 13.8, so they will have to improve upon that for them to continuously pay out dividends to shareholder. So we just have to wait and see with that. When it comes to the 20.8, I remember the video I did the last time. I said it was quite shocking for me to see that GCB, and not just GCB, but EcoBank as well, these two companies are trading at lower PE ratios compared to that of, Access Bank, Standard Chartered, and I don't know if Republic was part, but then we have the two biggest banks in Ghana, GCB and EcoBank, trading at PE ratios which are lower compared to that of other banks that are relatively less compared to GCB and EcoBank. So I do agree with them. I think GCB should be trading at the same multiple as the other banks, or even a little bit higher, because as an investor, you should expect that companies that we expect to be stronger, growing faster, we are going to price that more into the stock, because we expect that that company is going to deliver more returns to us as shareholders. But there's also an argument of the other companies, are they trading at fair valuation? Do we expect that their PE is good enough for banks? If not, then why should you expect that GCB's PE ratio should also go there as well? You should expect theirs to come down rather, so that they come and match that of GCB. So that's also an argument. But I do agree with them in terms of the long-term perspective. I think GCB is the strongest buy. I've made a video already saying that this is the company I would pretty much go with if I was investing into any bank right now in Ghana. So I do agree with them. As for the 20.28, let's be honest, the company, there are cheaper periods you could have bought the company. At the beginning of the year, I think it was trading as 3, 4, 5 Ghana Cedi. So there are cheaper times you could have bought this company. But then we should always be focused on performance, not price. So I probably would have to do a little bit review to see if I do agree with this price point. But in terms of the long-term buying recommendation, I do agree with them. So that's the end of this particular video. I think this was very fun. If you guys are interested, I'll do a part 2, because they did a lot more recommendations that I would want to go over as well. There's other companies that are also in my Cedi Farm portfolio, others that are not, that I want to go over. So thank you so much. Comment down below what you think about these companies. Do you agree with them or with my points? What are your thoughts on them? I would really love to know. Comment, like, share, subscribe. Please, thank you so much. Until we meet again, have a wonderful and blessed rest of your day. Peace.